Well, if you're confident at investing your self-managed super fund, you shouldn't be missing out on the value of non-investment strategies. This, according to my next guest, Liam Short from Sonus Wealth. Liam, what should we be doing here? Good to see you.
Yeah, look, I'm seeing a lot of clients at the moment. They're doing really well investing. It's been a great year in the markets, but they're missing out on some of the other strategies they should be doing. So I had a new client phone me this morning, and during the conversation, his concern was ANZ dropping their dividend and things that he was going to miss out on some income. But he was 68 years of age and hadn't moved into pension phase. I said, look, the basic thing to do is move into pension phase now. Instead of getting a 15% rebate on your franking credit, you'll get the full rebate. So just missing out on things. Most of the balance was in his name, not in his wife. So he was going over the 1.9 million. So just look at the strategies for spouse splitting, for contribution planning, looking at the recontribution strategies. Don't just focus on the investments. You can also boost your return by being smart and using the strategies available to you.
Well, it's always about being smart and using those strategies. But what about if you have done the wrong thing and you face a fine? Tell us about what some MSF members could be up against.
All right. So there's a penalty regime. So the ATO have three things that they can hit you with. They can hit you with rectification, fixing something, education requirements to make sure you're a suitable trustee for the future, but also a penalty regime. And those penalties have gone up, the units have gone up from $313 per unit to $330 per unit from this week. So that means somebody who's caught doing an aerial release or a serious infringement, they're looking at a fine of up to about $19,800 per trustee. So it's really important that you understand that you must stay on the right side of the ATO. And often, if you use the early disclosure when you've done something wrong, and you show them what you're going to do to rectify it, they will not penalise you. They will work with you to get your fund back in place, and they may just say, do the rectification and do some education, and we'll forego the penalties. But if you try and hide something, they're going to come and they're going to smash you with the penalties.
Yeah, I wouldn't ever try and do anything that you are going to be up against a big fine like that. ETF and index options soaring, though. What does that mean in terms of where we're seeing some outperformance?
Yeah, so it's one of those years where the active managers seem to have called it wrong, or maybe some of the areas the active managers have gone into because we're in an area where interest rates have gone up so fast. A lot of private equity, a lot of venture capital infrastructure has suffered a little bit. So we're seeing, I deal with a lot of industry funds and retail funds, and we're seeing the index option this year outperforming from anything from 2 to 8%, the active version. So I'm not saying just go index or just go active. I'm a blender. I love the mix of the two. And over the long term, the two of them now are tracking roughly about the same for most industry funds and a lot of the retail funds. So don't be afraid to mix, and the beauty of it is you get the index funds at such a low cost. So for example, we're with a 50% blend in Australian Super of their balanced and their index diversified, you can get a fee as low as 0.32. So don't be afraid to look at your options in there, and to also be aware that index is improving. ETFs are doing very well. I still prefer the broader ETFs than the sector specific or the thematic ones, but more and more people are picking some of those thematic to just diversify their fund into areas where they've got interests.
Okay, Liam, you talked earlier about some of these super splitting spouse contributions in terms of non-investment strategies. What about contributions like downsizer contributions? What should people be doing here?
Yeah, so look, one of the government things that they did last election to try and sweeten, and make themselves look good was to say that, look, you could do the downsizer contribution where that allows each member of a couple to put in 300,000 each into super when they sell their property. They reduced the age that you can start that from 55. But I'm really warning people, it's a one-off event. You can't use it again in the future. So for somebody who's around 55, they have the ability still to do non-concessional contributions, 120 a year or 360 every 3 years. So I'd be very reluctant to use the downsizer between 55 and 60 because it's probably not going to be your last move. And with inheritances coming through later in life, because your parents are lasting long. What I'm finding is people are getting inheritances around 74, 75, and that money's stuck outside of super. So basically, what we're saying is just try and manage your contributions over time so that you don't use the one bullet one early when you can use it later on when you might need it.
Now, it feels like tax season is just over. Of course, if you do your own, it was the October 31 deadline. But now there's the 31st of December deadline for aged pension members and their Centrelink income schedules. Tell us why we need to be aware of this.
Yeah, so with a normal income stream from a retail or industry fund, they will report to Centrelink every March and September about what your current income stream is. There's a little bit of leeway given for SMSFs. You have to report your pension balances on the 30th of June and the income that you're going to take for the year. You must report that by the 31st of December. What I'm finding now is the Centrelink are sending out regular reminders about this, and they're getting fairly to the stage where they're going to get nasty with people if they don't have those balances in by the 31st of December. They're basically giving them 6 months. So don't be lazy. Get the information into your accountant. Chase your accountant to get the financials finished, get it through the audit, and then upload the income streams to Centrelink. Just keep them on the right side.